Hello, everyone. Welcome to today's session from Impact Taxation and Financial Services. Today, we'll go through a case study to show you how a smart business owner can reduce 200K or tax on 200K profit, basically to zero. All right, let's have a look. Before we go to the main content, a quick declaration. The information provided is for general guidance only and should not be considered as personalized tax advice. We recommend consulting a qualified tax advisor or planner before implementing any tax planning strategies. Please note that we're not licensed financial planners and do not provide financial product advice. For tailored investment guidance, consult a licensed financial planner. All right, let's have a look at the case study. So the client profile, a business owner operating through a discretionary trust or a family trust. Okay, generated 200K annual profit and has spouse and 2 adult children with minimum income. Also has a self-managed super fund. And the family trust has a bucket company or corporate beneficiary that's not a base rate company, so the tax rate is 30%. And then the spouse and adult children also help out the business as employees. Okay, so because of that reason, they can receive FBT, fringe benefit tax exempt benefits, okay, such as office meals, minor benefit, etc. And also other home office and occasional business travel are considered as well. With business travel, potentially the business can pay employees travel allowance based on ATO required daily rate. All right. All right, step-by-step tax reduction strategy. Number one, distribution through salary wages, or it can be partially family trust distribution. 60K to the 3 family members. So basically, at the moment, the tax-free threshold is $18,200. But when we combine the $700 low-income earner tax offset, basically someone earning 20K, tax rate will be 0, okay, on the individual taxpayer. Okay, second strategy, maximize super contribution, 60K. At the moment, concessional super contribution cap, 30K. All right. So 20K each for each family member for the spouse and 2 children. Okay, write-off business assets. The instant asset write-off this year, the cap is still 20K. So when a business is buying any asset per item, if the item is actually below 20K cap, the business can claim an instant asset write-off. Okay. Number 4, prepaid expenses. Basically, prepay next year's expenses to this year. It's quite a common tax planning strategy towards the end of the tax year. Basically, this is mainly to delay the tax to future years, or basically to or pay less this year and then to get the advantage earlier for the on the tax benefits. Okay, so but earlier by 12 months. Okay, FBT exempt benefits, meals minor benefits we mentioned before. Okay, home office travel deductions combined together 20K. Number 6, distribution to bucket company or the corporate beneficiary. Okay, 15K. All right, and let's have a look at the bucket company as well. Yeah, so it's just a special arrangement here. I want to explain a little bit more. So 15K distributed to corporate beneficiary will be taxed at 30%. So the tax will be 4,500. So this profit can be retained or reinvested. So potentially it can also be reinvested back to the family trust through a Division 7A loan. Okay, and then also tax paid by this bucket company can also potentially come back to the family members if the structure is set up correctly. Okay, in future years. So the franked dividend paid out when the dividend is paid out, the franking credit attached to the dividend can come in as a tax offset in the future, okay? Or potentially can be a refund if the person's income tax in that year is actually below the tax rate threshold. All right. So effectively, it can also reduce the tax rate to 0%. It just in future years, like a delayed saving. All right. Now let's have a look at the total, the combined position. Okay, family distribution 60K, super contribution 60K. Both of them are zero tax. Okay, asset write-off, deduction right away. Prepaid expenses. Okay, basically we're pushing or getting the deduction earlier than next year. Exempt benefits, home and travel deductions, 25K. Bucket company distribution, the $4,500, even though the tax need to be paid, but it's actually deferred tax saving. Okay, in the future, the family members, if the structure is correctly done, in future years, they can actually get the tax back as a franking credit refund potentially. Okay, the total reduction is 200K. So effectively, for the trust structure for the business, tax will be zero for the current tax year. All right. Okay, so conclusion and key considerations. Tax can be reduced to zero with structured planning. Okay, ensure documentation and compliance. Of course, all the strategies I mentioned them very quickly, but every single strategy I mentioned, we could extend to hours of discussions. Family trust is one of the main structures that's going to attract a lot of ATO focus. So we need to make sure that everything will have to be in compliance with tax office requirements. So that's the reason why before you implement any of these strategies, you have to talk to us or a qualified tax planner. Okay, majority of the tax agents in Australia, they might not be able to provide complicated tax advice like this. So you need to be careful. Okay, find someone qualified and with the necessary experience and expertise. Okay, tax to bucket company is deferred and can be claimed back on personal level as franking credit offset on future dividends. Okay, even though you have to pay this year, but the benefit potentially you can receive back in the future. All right. Annual review of strategy essential due to ATO rule changes. Okay. Every year, 1st of July, there are multiple factors that will come in that will change tax law requirement. So you do need to review the strategies. All the strategies I mentioned is only valid as of now. Okay, I'm not sure after 1st of July. Okay, or there might be minor adjustments, so you need to be very careful, especially all the caps. Okay, the super contribution caps, the travel allowance daily rate caps. Yeah, you need to make sure talk to a tax planner and monitor those caps and rates so that you're not exceeding the ATO required amount. Okay. All right. A brief introduction about myself. You can pause the video to have a quick look, and also we have included our contact details here. If you have any questions, send us an email or give us a call. Thank you, and we'll talk to you in our next session.